Good morning. Welcome to Stock Market Today. It's Monday, March 30th, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _ CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where you can see a lot of the content that we get for this show, as well as see some potential stock ideas to consider that hits your inbox every trading day before the market opens. So hope everybody had a great weekend. Let's dive right in now. U.S. equities closed lower in Friday's trading, finishing just off the worst levels after a late afternoon bout of weakness. Utilities and REITs were the only sectors to finish higher on the day. Energy and technology underperformed. Treasuries were stronger, with the curve flattening. The dollar was weaker on the major crosses. Gold finished down 1.6%. WTI crude down about 4.8% on the day on Friday. And as we get to the desk this morning, futures are oscillating between small gains and small losses after that sharp bounce last week, notwithstanding Friday's weakness. Asian markets were mostly lower overnight, with Japan and China underperforming, although they did recover from weakness in the morning session. European equities are under pressure. Treasuries are weaker, and the dollar is weaker against the majors. Kind of a mixed bag as I think about it. After falling 4.3% last week. Gold is down 30 basis points. WTI crude is down 5%. It briefly traded below $20 a barrel at one point last night. So we're still talking about risk appetite in the marketplace, although now we're going to define it by key retracement levels. So let's take a look at the charts here for the S&P 500. This chart is widely becoming extremely popular as people start to try to figure out where we could go within the context of a bear market bounce, right? So for me, what's important to understand is on the way down, we cut through key support levels like they didn't even exist. And now as we rally, we want to see how the market reacts to key resistance levels, right? So far on its first test or first rally attempt, we faded from the 38.2% retracement level at, call it 2647, let's say 2650. Above that, we have to start thinking about 2790 and then 2930 as other important retracement levels on the way up. Initial support back around 2350, call that the December 2018 lows. Below that, next key levels are in the 2000 to 2100 range if 2350 fails to hold. RSI is holding bearish ranges, but there is a small bullish divergence. We'd love to see, if you're bullish, you want to see the market kind of take out this first resistance level following this bullish divergence and actually see the RSI move above 50. So far, that is not the case. Chaikin money flow is bullish. So really, we're trying to figure out who's in control, right? Right now, it appears that the bears are obviously in control. And if the market continues to fail at resistance levels after cutting through support levels like they weren't there, that's a key market message. For those of you who watch the moving averages, it's amazing, gives you a sense of how fast this move down was, that we're just now seeing that that cross, right? The death cross as it's known. I'm not a huge believer, but it is there. People will pay attention to the fact that the 50 is on the verge of crossing the 200-day moving average. Let's move into our market in a minute now. What are we writing about in our note? Well, stocks closed near the lows on Friday. Treasuries consolidate in the context of an uptrend. Commodities remain under pressure, and that's even as the dollar has pulled back to a key support level. Futures point to a mixed open today, right? As we're kind of oscillating between small gains and small losses here through the morning. As we take a look at the major indices from a power bar perspective, still a lot of carnage when it comes to the power bars. The Dow lost 3.71% on Friday, 0 bulls, 6 bears. S&P 500 down 2.8%, 3 bulls, 141 bears. The NASDAQ was an underperformer. All right, we've been calling the NASDAQ the cleanest dirty shirt, but it is an underperformer. 4 bulls, 23 bears there, and small caps also underperformed again on the day. That's not a new trend. 63 to 490 bulls to bears. Flight to safety sends bonds higher, yields lower. According to the Chaikin Power Bar, small cap stocks and large cap stocks remain strongly bearish, and the major indexes across the board are strongly bearish. Taking a look now at what's happening in lieu of the stock of the day, we're looking at a screen of the day, right? And I wanted to screen for what we call quality. Names that you want to be adding to a watch list should we begin to stabilize, right? Names with some solid relative strength. In our case, we're looking at our factors, the financials, earnings, and experts, and if those are all bullish and the stock has a bullish, very bullish, or a neutral plus rating, we want to be paying attention to those names, maybe staying engaged with the market and doing some work there. Money flow strong, relative strength strong. We kick out 20 stocks that fit the bill here, and if you want to take a look, you can see that these are the stocks that have the potential to be market leaders when we do stabilize. So it's gotten a lot of positive feedback about offering up some screens. So I just wanted to kind of show that to everybody here today. Turning now to our sector tracker, movement of the major sectors over the last 5 days. We can see for the first time in a while, actually, all the sectors are positive over the last 5 days. That's after that big rally in equities that we saw last week. But what's interesting to me is look at the leadership, right? The leadership is defensive in nature, utilities and real estate, kind of the beat down rebound playing out in the industrials and discretionary. Financials, tech, energy, and materials are middle of the road. Healthcare, comm, and staples at the bottom of the list. So after a strong rally last week, despite the weakness on Friday, all the major sectors finishing higher over the past 5 days of trading. Now, our industry in focus, however, is one that's been extremely weak. Bank services, right? Over the past 6 months, it's been an underperformer, lagging the S&P 500 by nearly 21%. Power bar ratio, which measures future potential, is very weak, as it is for just about every one of the industry groups. 0 bulls to 12 bears earns it a rank of 20 of 21 subsectors, and some of the indicative names there with very bearish ratings: Lending Tree, TREE, Community Bank, CBU, and Commerce Bank's shares, CBSH, as I said, all with very bearish Chaikin power gauge ratings. And if we take a look at the chart, we could see just the precipitous decline, right, that lines up with the S&P 500. However, it's been worse. Look at the relative strength, right? Started to underperform the market back in early January and continues to do so throughout the first quarter. Now, the ETF rating is neutral, but the trend is weak below this declining long-term trend line. Rebounded here with the market just a bit, but not a ton from a relative strength standpoint. At the same time, our overbought, oversold indicator is reaching an overbought condition, while Chaikin money flow remains bearish. What I've done here is I kind of went into the KBE and I highlighted the names that are bearish. So you can take a look at those here. These are certainly names where you potentially want to avoid those, not necessarily go bottom fishing if you are thinking about looking for names in this beaten down area of the market. Not a strategy that we think is helpful, notwithstanding that different strokes for different folks. We know everybody views the market differently, but these are the stocks that have bearish or very bearish ratings that are holdings within KBE. So just something to be aware of. I wanted to highlight there for everybody here today. Taking a look now at what's trending. Yesterday's S&P 500 gainers and losers, or Friday's gainers and losers are movers and shakers. Obviously, a lot of moving parts here in different areas of the market, different areas of the economy. EXR, didn't see anything company specific there. REITs had a decent day and rebounded a bit. So EXR up 6.9% on the day. Avalon was actually downgraded on the 26th by Piper Sandler, AVB. That stock did rally, though, on Friday, up 6.1%. UDR, they reiterated their 1Q guidance, which is kind of interesting. We're seeing a lot of companies pulling full-year guidance, but UDR said that they will address their full-year guidance on their conference call when they release 1Q numbers, but they did reiterate their guidance for the first quarter, so that sent that stock higher by 6.04%. AIV, similar story. They reiterated their first quarter guidance on the 24th. They did, however, pull their 2020 guidance. That stock was higher by nearly 6%. On Friday. I'll note that UDR and AIV are very bearish and bearish, respectively. And EQR, another REIT, no real news there, company-specific news on that front, but the stock was higher by 5.8% on Friday. On the loser side of the board, the cruise lines come under a lot of pressure, as it's not clear that they'll be able to participate in any coronavirus stimulus packages that are announced has to do with where the companies are domiciled, where the majority of their workers are located. So that was enough to send Norwegian Cruise Line down nearly 24% on the day on Friday. A lot of volatility over the past few days in these stocks. Carnival Cruise Line, a lot of moving parts in this one. They did, announce a new debt facility to the tune of about $7 billion. Stock was upgraded today in a news headline that I saw, but that, whatever, that's after a 19% decline on the day on Friday. Royal Caribbean, part of that same group, RCL. Nothing company specific in that name, just kind of building in with what's going on, the dynamics of that group as it relates to coronavirus stimulus plans. RCL down 15% on the day. Harley Davidson, they withdrew their guidance on the 26th. That stock was down 14% on Friday, and OKE, neutrally rated stock, didn't see anything company specific there. Stock lower by 14% on the day. So let's dive in now. We looked at the chart of the S&P 500. We have had this kind of interim rally in the equity market. What I will point out, though, is remember we showed you the sector tracker, right? Very defensive in nature. Utes had a huge week last week. So just something to keep in mind that the rally was led by what is traditionally a defensive area of the market. We're watching those key retracement levels to the upside, but we also want to pay attention to what's going on, in other areas of the market. That inter-market approach is really important. As we look here at Treasuries, the iShares 7 to 10 year Treasury bond ETF, that is consolidating now, breaking slightly topside from this consolidation. What I see here is we went parabolic. Remember a few weeks ago we talked about the parabolic move that we're seeing in these Treasury products, and that produced a massively overbought condition on the RSI. We've subsequently consolidated, but notice that during the consolidation, the RSI did not get much below the 50 level. So very much holding bullish ranges, and now looking topside through this consolidation zone by one day. Obviously, we want to see what happens today. But what I will note is that on a relative basis, Treasuries have been a big outperformer against the broader market, the S&P 500, all at the same time while holding above a steadily rising 200-day moving average. So just something to keep in mind here. We want to pay attention to what's going on across asset classes, see how that could be driving what's happening in the equity market. So this interim rally off the lows and Treasuries sends yields lower, right? Also helps those bond proxy areas of the equity market, which is, I think, a big reason why you see utilities and REITs at the top of the sector tracker over the past 5 days. The flip side of that is you can make the case that the market continues to price in slower global growth. And I say continues because it's not a new phenomenon. It didn't just arise with COVID-19. We track the copper and gold ratio on Fridays in our notes. We think that's a good proxy for expectations of global growth, and that's been slowing down for over a year. So as we take a look at the commodity complex, DBC, the Invesco DB commodity ETX, right, steadily below the 200-day moving average, precipitously below might be a better definition. But what's interesting to me is that on the rally attempt, right, look at equities. Equities are now testing this 38.2% retracement level. We're not even close for the commodity complex, right? Pinned in bearish ranges from a momentum perspective as the RSI has been oversold multiple times over the past few months, and rally attempts don't get out of bearish ranges. So momentum clearly to the downside as we think about the commodity complex. And as we look, though, on a relative basis, maybe one bright spot that we could want to maybe be thinking about is the fact that we are now holding this lower support relative to equities. We'll see. That needs a lot of time to play out, and it is a relative trend, right? On an absolute basis, still seeing a lot of weakness, but we want to pay attention to possible inflection points in the marketplace. So I will watch this relative performance of commodities here in the near term, and it's all playing out as the dollar pulls back. Dollar had a big run, right? There was a dash for dollars, right? And now we've pulled back and we're testing this support level at the 50-day moving average. RSI holding bullish ranges, right? You can see here that dollar strength precipitates and accelerates commodity weakness. So it's something we're paying attention to. If the dollar begins to rally from this support level, I'd expect the commodities to continue under pressure. That'll wrap us for today. Head over to chaikinanalytics.com/test drive. Sign up for the trial. I'll be back with you tomorrow.